Hello everyone. Today we are going to talk about capital budgeting in conditions of certainty. This is a very important topic because today we are going to discuss about the net present value, about the internal return rate, and many other profitability indicators that are well known, but probably they are not put it in the proper perspective. So today we are going actually to talk about those indicators. What are our learning objectives for today? So today we are going to start talking about the essence of valuation. This is critical because actually the essence of valuation means that there is an underlying philosophy in the way we evaluate every asset in finance. And this underlying philosophy is related to what? It's related to the human beings. Okay, so we are going to learn how we actually portray the psychological portray of a human being in such a way that we can start getting to know that every single equation in finance is related to this psychological portrait. Then our second learning objective is related to what do we mean by capital budgeting under conditions of certainty. This is also very important because although capital budgeting deals in general terms with long-term investments, now we are going to start talking about specifically conditions of certainty. Then we move on to the opportunity cost of capital, the way in which we can approximate this opportunity cost of capital, which depends heavily on the perspective. Actually, it could be an institutional perspective, it could be a personal perspective. So if this is the case, so we have different proxies for this opportunity cost of capital. And finally, we are going to review the main important different investment criteria. Okay, so we are going to review what is the net present value, its interpretation and calculation, and it's very important to distinguish between both of them. Then we are going to start talking about the internal return rate. Then we will move on to talk about the payback period, and finally the profitability index. So all these investment criteria are really not really criteria, but investment profitability indicators when we talk about conditions of risk. But they are investment criteria, only the net present value, if we talk about actually conditions of certainty. Okay. So what is the essence of finance? Well, if I'm asking you actually three different questions. So the first question will be, let's suppose that I have in my left hand a bag of $100,000, and in my right hand two bags of $100,000 each one of them. I mean $200,000. So which of the two bags would you prefer? Definitely you will say, hey Sam, is an obvious question, an obvious answer, so probably you will prefer my right hand, which by the way has the $200,000. Well, the second proposition will be, let's suppose that I can give you these $200,000 today, or I can give you these $200 in 1 month, and there is no going to be any interest paid if you receive these $200,000 in 1 month. What would you prefer? Again, you would say, hey Sam, it's an obvious answer because definitely I would prefer the money right now. And finally, I can actually propose to you that you can earn these $200,000, but if you actually play a lottery, and this lottery is being built by the following: 0.50%, I mean 50% that you are not going to lose anything but earning nothing, and 50% that you could earn these $200,000. What would you do? Some of you will run the lottery. Some of you don't. But actually it's an obvious answer. Since you are not going to lose anything, so it is convenient to run the lottery, right? Because you don't have anything to lose. So on the other hand, let's suppose that I change a little bit. I reframe a little bit the lottery. So now you could lose $100,000 with 50% chances, or you can actually earn $200,000 with 50% chances. So now probably many of you are not going to run the lottery. But what about if I increase the opportunity of winning $10 million and losing $100,000. So probably some of you will run the lottery. What I'm trying to say that is that according to all these very simple examples, you are greedy, impatient, and risk averse. And this is the underlying philosophy that actually we assume in finance. I mean, in finance, we assume that people is greedy, so they prefer more cash rather than less. Is impatient because they will prefer the cash right now instead of later. And actually, they are risk averse because they prefer to have actually a higher return whenever they have to face a higher risk. So this is the essence of valuation, and this is the essence of what we call the present value. So this is the $1 million formula that actually explains how we can evaluate any asset. Okay, so for instance, an asset that provides us with these cash flows or free cash flows, discounted back to the present, to the proper opportunity cost, actually cost of capital will actually provide me with a present value. If I subtract from this formula the initial investment or my initial cost, this is what I name as the net present value. Well, what about capital budgeting? Well, capital budgeting in conditions of certainty deals with capital expenditures and long-term investments. Okay? But long-term investments and capital expenditures of a certain type. I mean, the type of risk-free. Well, actually, we have some examples, such as, for instance, machinery maintenance or replacements. These are a couple of examples of risk-free project, more or less. Okay? So whenever we deal with capital budgeting in conditions of certainty, so we actually deal with risk-free investments. Okay? Long-term investments. In this particular situation, actually, you could see that we are dealing with fixed assets, right? In the left-hand side of this slide, so we can see that actually we deal with fixed assets, okay? But we do have also different type of decisions within a company. Well, we could have the working capital management decision. We could either have the capital structure decision, okay? Or we could either have actually the capital budgeting decision, or even the dividend policy decision or the dividend distribution decision. So these are the 4 basic decisions in a company. Anyway, today we are going to deal with long-term investments under conditions of certainty. Well, so a natural question will be, hey Sam, how we can actually discount back to the present all the future free cash flows that this long-term investment will provide me? Well, actually, we could use the risk-free rate. So the risk-free rate, what it is an abstract concept. Well, it's an abstract concept because it doesn't exist in reality. Because a true risk-free rate would mean that you are going to have a secure return no matter what happens in the future. And nothing will secure you this. Remember that the only things that are secure are debt and taxes. So actually, we have different proxies for the risk-free rate. Okay, and these proxies depend on what? On the perspective we take. Okay, but let me tell you a little bit about the properties of a risk-free return. So a risk-free return must be, first of all, default risk-free. I mean, the issuer has to pay anyway. Okay, no matter what happens in the future. Secondly, it has to be identified in a certain monetary unit, because it's not the same speaking about the risk-free return in US dollars rather than the risk-free return in Mexican pesos. And why so? Because actually there is what is being called the exchange rate risk. I mean, the fact that the exchange rate between the US dollar and the Mexican pesos actually suddenly jumps, okay, unexpectedly. Then it has to be a return without inflation. So it should be a very short return. And it should be free of interest rate risk. I mean, the fact that suddenly interest rate will jump, so then the risk-free return will also jump. Okay? Well, as I told you, the risk-free return could be approximated by different proxies depending on the perspective. So if we talk about from the perspective of a mutual fund, okay, or investment fund that actually it has a lot of capital to invest in many different securities, financial securities. So definitely a denomination of, let's say, 100,000 pesos or 1 million pesos that a treasury bill from the Mexican government could offer, okay? So definitely it's possible to be purchased, but not from the point of view of a pedestrian, okay? So I mean, from the point of view from the personal point of view, it is a lot of money. I mean, to invest like 100,000 pesos in just one single financial security. So that's the reason why there is two different perspectives. So the first perspective is from the institutional investor point of view, which means that the risk-free rate could be approximated by using the short-term treasury bill from the government. Or alternatively, what you could use from the personal point of view is that the risk-free return or the opportunity cost of capital could be approximated by what? By the return that banks are being offered for a fixed time period. Okay? These are secure returns for a fixed time period that the banks are offering to personal customers. So that's the reason why we could take it as a proxy. Okay? Anyway, regardless on the proxy you take in order to calculate the risk-free return, something that you actually have to consider is the fact that under conditions of certainty, the net present value and only the net present value is a sufficient investment criterion. It means that actually by calculating a positive net present value, you can go for the project. Okay? And if you have a negative net present value, so you reject the project. However, under conditions of risk, not only the net present value, but also the other profitability indicators that we are going to talk about, such as the internal return rate, such as the payback period, such as the profitability index, are not sufficient investment criteria. So definitely these are only profitability indicators. So let's talk about the net present value. So what is the net present value? Here, there is a lot of tendency from the students to actually say that the net present value is the present value of future cash flows bringing back to the present, to the proper opportunity cost of capital. But definitely this is not the way you should think about the net present value. The net present value is an added value or is a marginal value above the opportunity cost of capital of the investment. In other words, the investment is going to provide you with a marginal return in excess of the opportunity cost of capital. So you're going to earn the opportunity cost of capital plus the monetary units that the net present value offers you as being positive. Okay? So this is the way in which you should think about the net present value. Regarding the way in which the net present value is being calculated, well, this is another different type of situation, because the net present value, it is calculated indeed by bringing back to the present all the future cash flows, okay, which in this case we are considering those to become positive, okay, and subtracted from the initial investment, okay, and those expected free cash flows are bringing back to the present to the opportunity cost of capital. Okay, and then subtracted from the initial investment, and this is what we call the net present value. But this is the calculation. This is not interpretation, and you must never forget this. Let's put an example. So let's suppose we have an initial investment, an initial outlay of $1,100. The opportunity cost of capital is 10%, and we have for years 1 and 2 revenues and expenses. So it's absolutely easy to calculate what will be the free cash flow. So it's the difference between $1,000 minus $500, revenues minus expenses, and then we will get a free cash flow equal to $500 and $1,000. Next, we actually bring back to the present those free cash flows, and then subtract it from the initial investment, and getting $181. This means that by investing $1,100 in 2 years, you're going to get in present value an added value beyond the 10% annual return of $181. Okay, fair enough. Another point that we should actually pay attention is the exponents at which we are actually bringing back to the present those free cash flows. So for instance, for the first year is 1.10, I mean 1 plus the opportunity cost of capital to the power of 1, and in the second year, the actualization factor will be 1 plus the opportunity cost of capital to the power of 2. Why so, Sam? Well, because actually we are assuming that there is no risk. So the only difference between year 1 and year 2 is the time value of money. Since there is no risk, okay, because we are under conditions of certainty, the discount rate stays exactly the same. So nothing happens, and so we could actually bring back to the present those free cash flows to the opportunity cost of capital to the power of 1 and to the power of 2, depending on the 2 different years. Well, another situation which is of particular interest is the fact that there is a convex relationship between the net present value and the discount rate. So if you pay attention here, the higher the net present value, the lower the discount rate. And the lower the net present value, the higher the discount rate. There is a discount rate of particular interest, the one that we call internal return rate, as you see here, which happens to be the discount rate that occurs when the net present value is equal to 0. And shortly, we are going to discuss about this internal return rate. So what are the properties of a good investment criterion under conditions of certainty? I would say that the properties of a good investment criterion, which by the way is being fulfilled only by the net present value, are the following. First, it considers all the free cash flows, not the free cash flows up to a certain point of time, but all the free cash flows that the project will provide you. Secondly, it takes into account the time value of money. Third, it discounts the free cash flow at the appropriate opportunity cost of capital. And fourth, it selects the best investment or the best alternative investment from mutually exclusive projects. So I'm going to explain myself shortly. I'm going to use this as an example, the payback period. So for example, what is the payback period? The payback period is the time we should wait until we recover our initial investment. Okay? So the result is being provided in time units. How we can calculate the payback period? So let's suppose we have an initial investment of $1,000 and we have free cash flows equals to $200, $400, and $600 in each one of the first 3 years. So now we calculate the cumulated cash flow by adding up in a cumulative way those cash flows. Remember that here we are actually not paying attention to the fact that we cannot sum up free cash flows from different time periods because of the time value of money. I mean, because of the fact that $200 in year 1 are not exactly the same as $200 in year 2, because I could invest the $200 in year 1 and get a return for year 2. But anyway, regardless of this situation, so let's suppose we can accumulate those free cash flows. So for the first year we have $200, for the second year we have $600, which is 200 plus 400, and for the third year we have 200, 400, and 600, $1,200. It is absolutely clear that in one point during the third year we are going to recover the $1,000. So how we can calculate this? So the only thing that we need to do actually is to run a simple interest rule. Okay? So what we say is that at the end of the second year, as you see here, we still need $400 in order to recover $1,000. And these $400 are going to be collected when in the third year. But in the third year, I'm going to collect $600. So the question will be, if in the third year I'm going to collect $600, so in how much time I'm going to collect the $400 that remains? So I solve this rule and then I get like 2/3 years. Okay, so in 2 years and 2/3 years I'm going to recover the initial investment. What is the decision rule here? That you have to choose for, you have to choose for the investment project that provides you the recovery of the initial investment in the shortest time possible. Okay? What about the internal return rate? Well, the internal return rate does not have the shortcomings we have here. For instance, we do not consider in the payback period the full free cash flows, because beyond the third year, we do not consider the free cash flows. We do not bring back to the present, to the proper time value of money, and to the proper discount opportunity cost of capital, all the different cash flows, as you could see here. Okay, so there are many shortcomings related here. In the case of the internal return rate, we actually do not have the same shortcomings, but still it has a shortcoming which is very important to remember, as I'm going to show you to talk about shortly. So for instance, the internal return rate is the total return of an investment project. In other words, what I'm trying to say is that the internal return rate is not a marginal return. It's not an additional or added value return. The internal return rate is a total return. And this is a big difference with respect to the net present value, because the net present value is a marginal return. It's an added value above the opportunity cost of capital. But in the case of the internal return rate, unfortunately not. And this is a big difference because the internal return rate only makes sense whenever we compare this internal return rate with the opportunity cost of capital. I mean, if the opportunity cost of capital is higher rather than the internal return rate, so definitely the project is not worth it. On the contrary, if the internal return rate is higher than the opportunity cost of capital, so the project is convenient. Remember, we are talking about conditions of certainty. Okay? This is because if we have the opportunity cost of capital, so then we can move on to calculate directly the net present value. So why we should calculate or use the internal return rate anyway? There is an argument that actually favors the internal return rate, which is the fact that the vast majority of human beings prefer returns expressed in percentages rather than in monetary units. And this is precisely one of the reasons we still keep the internal return rate as a proxy. Besides, the internal rate of return has different other applications beyond capital budgeting, okay, that actually are very useful. So for instance, let's suppose that you go to a certain retailing company in order to purchase some clothes, and then you are going to pay, okay, the clothes in certain installments. Let's suppose in 3 different installments, okay. So the question is, how much is going to be your financial costs, okay, for actually purchasing these clothes in 3 different installments? Then you could use the internal return rate, and the internal return rate will provide you what is going to be the financial cost you pay, I mean the interest rate. Anyway, beyond that, let's go to the calculation, because the calculation is that the internal return rate is the discount rate that makes the net present value equal to 0. But this is only calculation, not interpretation. Well, now we have an investment project with an initial investment of $200, and then we have cash flows in year 1, 2, and 3 of 50, 100, 150. And they asked me to calculate the internal return rate. So if I do that, as you could see here, because it's the discount rate what I have to calculate, and this is very easy to calculate using Excel or financial calculators. Okay, so you calculate that the internal return rate is equal to 19.44%. Okay, so by investing in this project, so you are going to get about 20% return, total return. Okay, I could say that the project is good, but I cannot say if the project is better than my opportunity cost of capital. So I'm not quite sure whether I should go for this project or not, unless I compare it to my opportunity cost of capital. So the decision rule is that if the internal return rate actually is higher than the opportunity cost of capital, so I go for the project, otherwise I won't go. Okay. What about the modified internal return rate? So the big problem of the normal or traditional or total internal return rate is the fact that it assumes that cash flows or free cash flow are being reinvested at the actually at the same value of the internal return rate, which is not possible actually, because that would mean that you are going to get the extra return that you get, the free cash flow that you get from the company, and then you are going to put it into the company and expect a return which is going to be equal to the internal rate of rate. This is a problem because what happens if actually the internal rate of rate is below the opportunity cost of capital? So it wouldn't make sense to do so, right? So the best way to do it, or a better assumption actually, is to assume that this free cash flow, instead of keeping it, you keep it. What you are going to do is to put it back into the company or into your investment in such a way that you expect to earn the opportunity cost of capital. And this is the modified internal return rate. The modified internal return rate gives you the project total return you could earn by assuming that the free cash flows that you get from the project are going to be put it back into the company at the opportunity cost of capital. Okay, so how we can actually calculate this? First, by taking the n square, the n root of the future value of the positive free cash flows divided by the present value of the negative free cash flows. Remember that the negative free cash flows involve the initial investment, and of course the initial investment is not necessary to bring it back to the present. Okay, so as you could see here, for instance, in our example, we previously got like 20% internal return rate, but if we would have been calculate the modified internal return rate, so the total return will be lower, and it's going to be like 16.35%. Okay, so this is a quite different result. Okay, so it would be better to use the modified internal return rate whenever it's possible to calculate it. Why I say that whenever it's possible to calculate it? I say so because so far we have been dealing with conventional projects. So what are conventional projects? Conventional projects are the projects in which you have an initial outlay, right? Negative cash flow. And then for the remaining years you have positive ones. But what would happen if I have a negative outlay at the very beginning, and then I have like positive and negative cash flows all over the years? This is a non-conventional project. And in this particular situation, multiple internal rate of returns could appear. More than this, it is quite possible that the modified internal return rate cannot be calculated. So what we should do in this particular situation? Let's see. So let's suppose we have actually an investment project with the following free cash flow. The initial investment is $252, and then from year 1 to 4 we have different free cash flows, as you could see, and these free cash flows are positive and negative. So the first question will be, hey Sam, how many internal return rates I'm going to have? Well, actually you are going to have as many internal return rates as changes of sign you see in the free cash flows. So for instance, you see 1 change of sign, 2 changes, 3 changes, 4 changes. So you're going to have 4 different internal return rates. Okay? So if I calculated all the different internal return rates, as you could see here, actually I would have got 25%, 33%, 42%, 66%, and the natural question will be, hey Sam, which of the 4 is the correct one? The answer is no one. Because definitely this is not possible. It is not possible to calculate or to trust a certain internal return rate under such conditions. Okay? So if I actually draw what will be the net present value, okay, according to the discount rate, I would have got this graph in which you could see that all the internal return rates are positive integers. So it's not like we have negative integers, or we have like complex numbers or whatever. These are real numbers, and those real numbers are positive integers. So positive values. So actually we could use each one of them as being the internal return rate, and there could be the tendency of saying, hey, I'm going to use the result of the internal return rate which is the highest one, which of course is not correct. What about mutually exclusive projects? So whenever we talk about mutually exclusive projects, we are talking about projects in which we should do one of the two projects, but we cannot do both of them. Why we cannot do both of them? Because probably we are suffering from capital rationing. I mean, the fact that we have a certain budget for the year and we cannot do all the different projects we would like to do. So for instance, we have two different projects here, project A and project B, okay, with different cash flow patterns. And we could actually calculate the marginal project, which could be A minus B or B minus A. Okay, in this case, we subtract A minus B. And then we get these marginal cash flows. Why these marginal cash flows are useful? Because if I calculate the internal return rate of those marginal cash flows, I could be able actually to calculate what is being called the crossover rate. And what is the crossover rate? The crossover rate is the Fisher rate, which is the rate that makes investing in project A or project B an indifferent decision. I mean, you could invest in project A or you could invest in project B, and you are going to be equally benefited by investing in each one of them. Okay? But what about if the internal return rate is higher than the crossover rate or the Fisher rate? If this is the case, so you would invest in project B. But if it's lower, okay, so then you would invest in project A. So actually, what dominates this decision is the net present value. What about the profitability index? Profitability index is the last profitability indicator we are going to discuss today. And let me start by saying that two different quantities could be compared in an arithmetic difference or a geometric ratio relationship. If we compare two different quantities, such as the present value of free cash flows and the initial investment, as a subtraction of the two of them, so then we get the net present value. And this is an arithmetic relationship. But if we compare these two same numbers, I mean the present value of free cash flows and the initial investment in a ratio, okay, so then we have a geometric relationship between both. So in other words, what I'm trying to say is that the profitability index is a different way of looking at the net present value, but actually is highly related to the net present value. Okay? The profitability index is very helpful whenever we are facing a situation of capital rationing, as we are going to see shortly. So, for instance, let's go back to our initial example. So in our initial example, we have an initial outlay or initial investment of $1,100. And the opportunity cost of capital was 10%. So actually we have the year, we have the free cash flows, and the question is, what is the profitability index? As you could see, the net present value was $181, but the profitability index is 1.16. What is the meaning of that, Sam? Well, the meaning of this is that for every dollar that you invest in the project, so you are going to have an added value of 16 cents. Oh, yes. And this is a way in which we can actually make a rank of all the different projects we have, ranging from the project that provides me the highest profitability index until the project that provides me the lowest profitability index, and then investing in the projects that are in the top of the list, until we actually deplete completely the budget I have to invest. Well, anyway, guys, I hope this small capsule is going to help you, okay? And see you in the next one. Thank you very much for your attention.